Several of you have been asking in the comments whether the precious metals run already topped back in January, whether the excitement came and went, and whether the people saying the party is over are actually reading the room correctly. Today we are going to separate the noise from what is really happening on the ground. And you are going to walk away feeling a lot clearer about what buyers, collectors, and everyday people are actually doing right now. This is GoFinance. Here's how the lazy version of the story sounds. Metals had that huge run. Everybody got excited. Then prices dropped hard from the highs. That means the move is done. The easy money has already been made. Retail buyers got burned. Shops are probably quiet now. And the next wave, if there even is one, is going to take forever. On the surface, that sounds believable because when people remember a sharp drop, they naturally assume the whole trend broke. But when you look at what is actually happening at the shop floor level and line that up with recent market data, the picture gets a lot more interesting and honestly a lot less simple. Because this is not just a price story. That is the thing to keep in mind. This is a behavior story. It is a demand story. It is a trust story. A market can cool off emotionally without actually being dead. Buyers can become more careful without disappearing. A shop can sell through gold quickly, even while people online are telling you interest has vanished. All of those things can be true at the same time. The main question hanging over everything is straightforward. Was that big move earlier in the year the end of the run? Or are we still much earlier than people think? The answer coming from the shop floor is this. No, the run does not look finished. But yes, the next stage may feel different from the last one. That distinction matters a lot because people hear bullish and they imagine nonstop euphoria. That is not always how real markets work. Sometimes a bull market keeps going, but the crowd acts more cautious because it remembers what happened the last time things got too hot. Memory changes behavior. If somebody watched silver rip higher and then watched it get slapped back down, the person may still be bullish. But next time, they are not going to react the same way at the first sign of excitement. They may wait. They may scale in slower. They may need more proof. That does not mean they turned bearish. It means they got educated by volatility. Now here is one of the clearest signals from the shop floor right now. It is not silver is exploding and everyone is going crazy. It is actually something more revealing. Gold is moving very well, in some cases even better than silver. That matters because gold buyers are often not impulse buyers. They tend to be more deliberate. They are usually writing bigger tickets. And when a shop cannot keep certain gold products around for long, that tells you this is not only a social media story, there is serious money still stepping in. That lines up with the broader backdrop too. According to recently published industry data, official sector demand for gold stayed historically strong through last year, and central bank buying remained elevated even at record prices. That does not guarantee higher prices every week. But it does tell you gold has had support from buyers who are not trading memes and who are not thinking in 48-hour windows. That kind of demand tends to matter more than the loudest headline of the day. Silver is where the emotion lives. Silver is where the stories get louder. Silver is where the smaller buyer feels like they can still participate. And that is powerful because it keeps regular people from believing they missed the whole move just because they cannot buy big. You do not need to be rich to get started. You do not need a giant order. You can start with something small, a silver dime, a single round, one little piece at a time. That message sounds basic, but it is powerful. It keeps this market accessible to the people who build it from the bottom up. Now, gold was trading in the high 4,000s this week. Silver was sitting in the mid-70s. The dollar index was just under $100 and lower on the day. The broad mood lines up with the market tone. Metals were firm. The dollar was softer. The backdrop still looked tense, even if the exact quote on your screen changed hour to hour. But here's where I want to push back on one lazy conclusion. A softer dollar and a strong day in metals do not automatically prove that everything is healthy forever. Markets breathe, they run, they pull back, they overshoot, they shake people out. One good day does not mean all clear. One ugly correction does not mean the whole thing is dead. The real clue is whether demand keeps showing up after the excitement fades. And from the shop floor, that answer is yes. Now let us talk about the collector angle because it adds a dimension most people miss entirely. There has been talk about a small batch of silver coins that may have come out in the wrong metal. If true, that is the kind of thing that makes ordinary bullion suddenly cross over into the collector world. Not because the metal is better, quite the opposite, because the mistake is unusual. I am not automatically in the camp that every mint mistake instantly becomes a jackpot. Sometimes the market for errors is deep, sometimes it is niche, sometimes everybody gets excited for a week and then the premium settles way down. But I do understand why serious collectors perk up when they hear a story like that. Mint errors are different from random damage, and the coin market has always treated certain genuine mistakes as special. A real mint error is an improperly made coin that escaped production and entered the market. And scarce errors can carry real collectible value. The big question is never just, was there a mistake? The real question is, how many got out? How clear is the proof? And how badly do collectors want them? That is where the value comes from. If you somehow ended up with a legitimate wrong metal bullion coin from a known release, you would not toss it back into a random pile. You would document it, you would verify it, you would probably have it certified. Because once you move from plain bullion into a specialized error, condition, attribution, and credibility start to matter a lot more. The coin stops being just metal and starts becoming a story. And story is where numismatics gets expensive. This conversation naturally drifts from bullion into the collector details that outsiders sometimes laugh at. Packaging and pedigree can change value in a hurry. There is a category of older coin holders that collectors call rattlers. Those early pieces from the grading boom of the mid-1980s. To a normal person, that may sound ridiculous. Why would the plastic matter? But in coins, the plastic can say something about when the piece was graded, how strict standards may have been, and how many of those original holders even survived. The early generation holders really did become known for that rattle effect. They were only around in that original form for a limited period, and many were later cracked open by people trying to get higher grades on resubmission. So when a nice one survives, some buyers absolutely care. There are also approval stickers that collectors pay attention to, especially the gold ones. In simple terms, that second opinion tells the market, this coin looks better than the number on the slab. A gold sticker means the coin appears better than its assigned grade. That does not mean every stickered coin should be bought blindly, but it does explain why people react when they see one. The market hears, this may be undergraded, and suddenly the same coin is being looked at through a completely different lens. Now, let us come back to the metals plumbing, because there is one part of this that most viewers never think about. Refiners. Most people think price goes up, shop buys metal, end of story. But that is not how the plumbing works. If refiners are backed up, slow, picky, or overwhelmed, that affects what local dealers can comfortably buy and how quickly they can turn material into cash. When refiner flow improves, better downstream liquidity means better conditions for ordinary sellers. Sterling starts moving again, old silver starts moving again, material that dealers were hesitant about becomes easier to handle, and when that happens, local markets function more smoothly. But one smart caution is worth raising. If too much material suddenly hits refiners again all at once, the system could get jammed up. Improvement is not the same as perfection. The pipeline can still get clogged. Recently published silver market forecasts still point to another supply deficit this year, which would extend a long run of consecutive deficits. At the same time, analysts have pointed out that silver's thinner market structure can exaggerate price moves, especially when speculative money gets whipped around. Put those two things together, and you get a market that can be fundamentally supportive while still feeling chaotic in the short run. That is silver in a nutshell. That also helps explain why a shop can sound constructive even after a nasty drop. Because from the shop perspective, the story is not only the chart, it is whether people are still buying, whether gold keeps disappearing, whether smaller silver pieces still move, whether customers are bringing material in, whether refiners are paying faster, whether collectors are still chasing quality. Those are real-world signals. And they do not always move in perfect sync with the emotional tone online. There's also the junk silver conversation that always comes back. For some buyers, those coins are not just about upside. They're about usability, small units, familiar forms, something that feels easier to trade if life ever gets complicated. Whether you agree with that mindset or not, it is real, and it makes those pieces sticky. People tend to hold them differently than they hold generic rounds. A silver round might be a trade. A modern bullion coin might be a trade. But a bag of recognizable old coin silver can feel like a permanent reserve. Not because it is always the best performer, but because the owner assigns it a different job. And once an asset has a different job, people behave differently around it. Now, one more fresh angle worth mentioning. High prices are pushing parts of the solar supply chain toward thriftier use and even substitution away from silver in some applications. That does not erase the bullish case, but it does remind you that very high prices can create their own response. Demand is not a statue. Industry adapts. The same is true for coins. High prices change behavior there too. Buyers get pickier. Sellers come out. Governments even rethink how much silver goes into certain collector pieces when costs jump around. Rising prices attract demand, yes, but they also trigger adaptation, rationing, substitution, and profit-taking. All of that is part of the same movie. So putting this all together, what are we really looking at? A market that may be bruised but not obviously broken, gold demand that still seems very real, silver demand that is still there but attached to a metal that can swing harder and scare people faster. Collectors who know mistakes can become treasures, but also know not every rumor is a windfall. A market structure where refiners, liquidity, and buyer psychology matter just as much as the spot chart. In a conversation that reminds you, prices alone do not tell the whole story. You have to ask who is buying. What are they buying? Why are they buying it? Are they buying one little piece at a time, or are they scooping up better gold as soon as it lands? Are they chasing hype, or are they acting on conviction? Those questions give you more information than a screaming headline ever will. Is the bull run over? The evidence does not support that. Could the path stay messy? Absolutely. Could silver still throw people around? Of course. But none of that automatically equals over. Sometimes the market is not ending. Sometimes it is just forcing the weak hands to relearn what they actually own. What to watch going forward. Watch whether gold keeps moving quickly at the retail level. Watch whether smaller silver products still turn over without much shelf time. Watch whether refiners continue improving. Watch whether the dollar stays under pressure. Watch whether silver keeps carving out a pattern of holding its pullbacks a little better than the doom crowd expects. One phrase captures the technical picture in the simplest possible way. Higher lows. A market can look ugly to people staring at the peak while still looking constructive to people studying the structure. Those are two completely different experiences. One sees disappointment, the other sees resilience. We are stackers here. We understand that the people with a plan handle volatility better than the people with only excitement. The person with a process survives pullbacks better than the person chasing candles. Start where you can. Build the habit first. Let the stack and the knowledge grow together. And if the market keeps pushing, great. If it pulls back again, fine. Either way, the people with a plan will usually handle it better than the people living from thrill to thrill. Drop a comment below. Are you still buying at current prices, or are you waiting for a better entry? Tell us where you're watching from and what your buying zone is. I read every comment, and I will pin the best analysis. If you want this analysis in your inbox every morning before markets open, join the GoFinance newsletter. Every day before the session starts, you get a direct summary of what is moving gold and silver, what the data says, and what to watch. No noise, no headlines. Just the information that matters before anyone else has it. Link is in the description and in the first comment below. Subscribe. Turn on notifications. Data before price. GoFinance.